So today we're going to discuss the very basic introduction to accounting. So what is accounting? Accounting is basically keeping track of all the financial transactions that happen within the organization, right? So essentially accounting is the language of the firm. This is how we make sure that we keep track of everything that is happening from a financial standpoint. So any monetary transaction that happens within the firm, both internally and with other firms, is going to be kept track through the accounting process. Okay, so who does the accounting? Well, there are two different types of accountants, public accountants and private accountants. CPAs, or certified public accountants, they are certified by the state to speak on financial matters for the firm. They do both internal transaction keeping, and also they prepare financial statements for external consumption. That will be mostly for investors and for the IRS, right? So what has happened with certified public accountants is that they've been in the news for the last 15-20 years, quite a bit. There's been quite a bit of controversy because, let's just say that the way financial transactions have been reported sometimes has not been very accurate. It has not reflected accurately the financial health of the organizations. The first piece of legislation that I have here, the Sarbanes-Oxley Act, was passed after the big financial scandals in the early 2000s of Enron. Essentially, what it tries to do is it tries to separate their four large accounting companies had both accounting arms and also consulting parts of their business. And what this piece of legislation does is it separates them to make sure that the financial incentives that the companies have to sell the consulting and the accounting were separate, hoping that because of that, the accounting will actually be more transparent. Because of course companies were basically doing the consulting part, and once that you're doing consulting for a firm, are you really going to be exacting on their accounting reports? Well, maybe you have less incentive to do so. So this tries to separate that, hoping that the financial reporting is going to be more accurate. And then after the crisis of 2008-2009, we have the Dodd-Frank Act that was passed by Congress. And this is a piece of legislation that tries to limit the amount of risk that financial organizations, especially banks, take on when they're doing lending to companies or to the public. So also because some of the reporting here was not exacting. So both of these pieces of legislation try to improve the financial fidelity of the accounting that is conducted by CPAs and CPA firms in general. Okay. And just in case, there is always checks and balances when it comes down to the accounting. There are accountants that are basically certified and dedicated to making sure that the financial statements that are presented by firms are indeed accurate, and those are both forensic accountants and certified fraud examiners. Okay. By the way, both of which are a growing field within accounting. So if you're interested in accounting, this is definitely an opportunity for you to work and making sure that firms are reporting accurately in their financial statements. And then finally, we have a large group of accountants that work for private firms. And if they pass a very stringent test, then they'll be considered certified management accountants. Now, like I was mentioning before, there are four large accounting organizations in the United States, and to be honest, they operate worldwide too, which are Ernst & Young, KPMG, PricewaterhouseCoopers, and Deloitte, and they do a large portion of the accounting in the United States. This doesn't prevent other companies from operating in this space as well. By the way, these are also interesting from their organizational perspective, as they are all partnerships. These are probably the largest partnerships in the United States. So when we're talking about how a company is organized, the 4 large accounting firms are operating as partnerships. So you can actually become a partner if you do a good job within these 4 organizations. So who actually gets to use the financial information created by the accountants? Well, everybody does, but there are 2 very distinctive uses of financial information. One is for internal use, which is basically used by the managers within the organization to know what's going on with the firm. So it's used both for planning and control. Control meaning whether you are actually fulfilling the objectives within the plan, and if not, to take corrective measures. That's what I mean by control. So the financial statements are actually used for that, so that you know what's going on within the firm and you can make plans accordingly. But also for external purposes, right? So first, if you have investors, they would like to know what the financial health of the organization is, wants to know what the results are. So investors use financial statements heavily so they can decide what companies to invest on. Okay. Also potentially other stakeholders, but then the other big party will be the government, because the government is interested in knowing whether the company is making money or not, and if so, it should pay taxes on it. So all these stakeholders are interested in knowing what the financial health of the organization is, and the financial statements that come from the accounting is what's going to deliver that information, both for internal purposes or external purposes. Now, within the accounting process, there are a couple of pieces of information that are absolutely essential. And I will argue probably the most essential of all of them is the accounting equation. So this is going to be laid out here simply, and it's an easy equation for you to remember, is that your assets, so what the company owns, are going to be equal to your liabilities, which is what you own to other people, such as banks, for example, in the form of loans, and owner's equity, which is the money that the investors have actually put on the company. Okay, so this equation is going to permeate and it's going to show up in all the accounting process. So there are a few equations only you're going to have to learn in this class. This is one of them, and it's easy, right? So assets is equal to liabilities plus owner's equity. Okay. Now the second very important principle in accounting is the double entry bookkeeping. So you have the accounting equation I just discussed, and it's going to come back again. But the second part to that equation is the fact that for you to keep that equation true as you go through your accounting process, you're going to have to enter every transaction in both the left side of the equation, which is the asset side, and the right side of the equation, which is the liabilities. Otherwise, that equation will not hold true. So if you change something in the asset side, unless you change either the liabilities or the owner's equity side of the equation, that equation will not be true. So because of that, what you're going to do is every entry that it's made in accounting is going to be a double entry. Okay, it's going to come on the left side of the equation and also on the right side of the equation, whether positively or negatively. Otherwise, the equation will not hold true. So this is what we mean by double entry bookkeeping. Now, how do you go about accounting in general? I'm going to walk you through the basic steps. We're not going to do a lot of bookkeeping within this class because this is just a very, very simplistic intro, but I'm going to walk you through the process, and then after that, maybe I'll give you a couple of small examples so that you can see what this will entail. Okay, let's go step by step. So the first step is to basically inspect the source document. So as an accountant, you're speaking about transactions within the organization, so you literally have to be looking at things like receipts, right? Where you are seeing what has happened with the money within the organization. So the first thing you need to do is make sure that actually whatever transaction you're going to record within the firm, it actually did take place. So you need some sort of physical proof of it. or maybe digital proof if physical proof is not available, especially given that a lot of transactions now are happening online, especially in the COVID-19 world, right? Then after you have observed and make sure that those documents actually exist, that the transaction did take place, what you're going to do is you're going to record that transaction into a journal. Okay. And a journal is just the time order list of all the account transactions. Okay. By the way, this doesn't have to be done in a physical journal. You can use obviously a digital journal instead. You know, there is specific software that is very popular in firms like QuickBooks from a company called Intuit, but there are others too. And then after you've kept the journal of all your entries, what you're going to do is decide where those entries are going to be placed within the ledger, which is basically a book, or nowadays probably not a physical book, but a file in a computer that basically separates all these transactions into different accounts. So you're going to have multiple accounts for each of the three broad categories in the accounting equation. You're going to have multiple asset accounts, you're going to have multiple liabilities accounts, and then multiple owner's equity groups, right? So you're going to have to decide within those where the different transactions are going to go. And then finally, what you're going to do with all those transactions is that you're going to prepare the financial statements for the firm, right? So you're going to prepare the income statement, the balance sheet, and the cash flow statement, which we will talk about these three as we go. Now, how do you summarize all this accounting information? We're going to create three statements, okay? And this is probably the most important piece of information that it's going to come out of the firm from an accounting perspective, which are the financial statements of the firm. We're going to talk about each of them separately. You have an income statement that is going to tell investors what are the revenues and expenses within the firm, and hence what is the profit. In accounting, income and profit really mean the same thing, okay? And then you're going to have the balance sheet, which is going to tell investors what kind of assets and liabilities the firm actually has at the moment. So that way you know whether you're going to be able to invest in this firm, what kind of liabilities are you going to be facing in the future. And then finally, you're going to look at statement of cash flows, which looks at whether you can actually afford payments in the short-term term. So it's looking at how much money comes in and comes out of the firm over time. Okay, so this is going to be important in my experience, especially in small firms, because a lot of the small firms that don't make it is because they manage, or they lack of being able to manage their cash flow. Okay. And now the way you create these financial statements is going to be different in different industries, but they all need to follow the generally accepted accounting principles when they are actually prepared. Now, let me just emphasize another thing that I was mentioning before. A lot of the terms are a little bit confusing in accounting, at least for me. And the reason why is because there are a lot of terms that are essentially equivalent, but they are using different terms. So if you look at financial statements for different firms, you may get a little bit confused because they might actually use different terms. So here you have a few that are commonly used interchangeably. So you have revenues, which is essentially the amount of money that comes into the firm, and those are oftentimes referred as sales or goods or services sold. Okay, so whenever you see that in financial statements, what they mean is revenue, how much money came actually into the firm. Then you have gross profit, okay, which is the difference between revenues and expenses, okay. And another two ways of saying the same thing is gross income or gross earnings, and all those three mean essentially the same thing. You also have operating income, which again, it could be used interchangeably with operating profit, like mentioned before in the presentation. But there are other terms that you might find also, like earnings before interest and taxes, or EBIT, which is used very commonly, or income before interest and taxes. Okay, I've already talked about the next term. And then you have net income, which is also interchangeably used with earnings after taxes or profit after taxes. And then finally, income available to common stockholders could also be used as earning available. So you can see that income and earnings are used interchangeably. So you need to watch out for that if you are actually comparing financial statements across different firms, especially in different industries. Now, let's talk about each of the financial statements a little bit more. First, let's start talking about the income statement. So what does the income statement tell you? It tells you what the profitability of the firm is, okay, over a certain period of time. Typically, it will be either a quarter, but some firms report biannually, so it could be 6 months, or it could be a year. Okay, so it depends on the industry, but over a certain period of time, it's going to tell you how profitable the company was. Okay, so it's going to give you a difference between the amount of money that comes in, which is the revenue, and the amount of money that leaves the company to achieve that revenue, which is going to be your expenses. And that's going to give you an idea of profitability. Okay. So like I said before, revenue, just the amount of money received for goods and services. One way you can think about it is revenue is going to be equal to your price that you charge times the quantity, right? So of course, if you have multiple products, this equation is going to get more complicated because you'll have different prices and different quantities. And this will include everything, not only products, but obviously services and any of the ancillary resources that can be considered revenue for the firm. Now, what are you going to see in the financial statement, in the income statement? You're going to have the amount of money that was coming from revenue, and that revenue is going to come from the goods that you sell. So one of the expenses that you're going to have is going to be the cost of goods sold. Now notice one thing, because you're going to have inventory, especially if you're talking about products, maybe not so if you're talking about services, because they cannot be inventory, right? But if you have some raw materials or any intermediate products that you actually create within the firm, you need to be aware of how we figure out the cost of goods sold, which is basically looking at inventory. So you're going to look at the beginning inventory. This is the amount of product that you have before the term where that particular financial statement is actually created. And then you're going to have the amount of purchases that are actually made for that product within the amount of time that financial statement is created. And then you're going to have the ending inventory. Okay, so what you had from the beginning plus what you bought minus what you actually have at the end, that's essentially the amount of product that was sold. Okay, this is the way you actually do it from recording purposes. Of course, you'll have to multiply this by prices. Okay, good. And so that's the cost of goods sold. It's something that you're going to see in the income statement all the time. Another thing that you're going to see is the computation you'll get at the end, which will be gross income, which is going to be your revenue minus the cost of the goods sold, okay, to create that actual revenue. So it's essentially the way you define profit usually, which is what comes in the firm, which is the revenue minus the amount of money that you spend to actually achieve it. Okay. Okay. What else are you going to have? You're going to have other expenses. Also, other than the expense of the goods that you're selling, you're going to have other things like marketing expenses, right? So if there are salespeople that you have within the organization, you're going to have to pay them, right? You're going to have other expenses such as rent, right? So if you have a facility where you're actually conducting business, that needs to get paid for, right? What else? Administrative expenses, right? So if you need to run an office, you'll have some people employed there, but there will be also office materials. That will be an expense that need to be removed as well. Then if you are creating products, you might actually have R&D expenses, right? So those also need to be removed to obtain the final profit. And if you're getting a loan from a bank to operate, you'll have to pay those interest, which will also be expenses for you. Finally, before we get to the net income, we're gonna talk a little bit about depreciation. Now, let me just talk very briefly about it. Depreciation is basically acknowledging the fact that when you buy, for example, a machine, let's just say that you buy a truck. You buy a truck because you need to deliver your product. So let's say that you are just opening a bakery and you need a truck to deliver your cakes to different places, right? Now, when you buy a truck, what's going to happen with it? Let's say that you pay $40,000 for a truck. When you spend $40,000, you will think, well, maybe I can just put on that expense right away in my income statement. But if you do that, it will not reflect the fact that the truck is still at the firm after this year. So let's say that you're doing a yearly statement, right? So if you spend $40,000 today, next year, you still have the truck, right? So what you're going to do to reflect the fact that some products are expenses for the firm, but the actual asset still within the firm, is we're gonna depreciate the asset. So what we're gonna do is we're gonna take that truck and over a series of years, let's say maybe 4 or 5 years, right? And there are tables that will dictate for you how many years you can use for depreciate, and it's something that is commonly accepted. Okay, and what you're going to do is you're going to take those $40,000 let's say, for example, if we depreciate over 4 years, and we're going to remove $10,000 every year instead of taking all $40,000 today, to acknowledge the fact that the truck's still going to be usable and can be used for a longer period of time. So depreciation is going to be another expense that is going to be included in the income statement, that is going to acknowledge the fact that some of the physical assets that you have are maybe a little bit less valuable over time. Okay, but they're still there. So we don't expense them right away. We just do it over a period of time, and we call that depreciation. Okay. Now, finally, what you're going to get in the income statement is going to be your net income, which is the total profit after you remove all expenses, and that includes also taxes, depreciation, and everything else. Now, let's be clear about one thing. While there are some accounts within the firm, the profits or earnings are not an account. So there is no such thing as an account that it's called profit, where you record anything. Profits are basically a result of calculations that you make from the actual accounts, both revenue or expense accounts within the firm. So they don't exist as an account, they just exist as a calculation that is done on the accounts where those transactions are actually being classified. Okay, so it's not an account per se, it's just a result of calculations. Okay, at the end of an accounting period, if some of those profits are retained within the firm, meaning that there is extra money on top of the money that was actually used because we're having a positive result, meaning a profit, there is an account where you can actually put that money as retained earnings, okay, that will basically go on the right side of our accounting equation as part of your owner's equity. Okay, so that's retained earnings. Okay, yeah. Now, talking about the second financial statement, we've already talked about the income statement. The second one is the balance sheet. So the balance sheet, unlike the financials, unlike the income statement, which is looking at flows of money in and out, balance sheet is a snapshot of the current financial position of a company. So it's not looking at things over time, it's looking at things today. Okay. And what it does is it mostly looks at assets and liabilities. Okay, we're going to see that in a minute. So what's going to be in the balance sheet? Well, you're going to have assets, like I said. And the assets are going to be distinguished into different categories depending on the nature of the asset. So you're going to have current assets that are basically mostly cash or other things that can very quickly turn into liquidity. Okay, so something that will be easy for a company to transform into money. We call that current assets. So maybe there are some T-bills or something like that, which are government issue that they can easily be traded. So that might be considered also a current asset, right? Instead of just having cash, maybe they have a little bit of money or money that you have in the bank, right? That you need to get out of the account as opposed to physical money. So those will be current assets. Then you have accounts receivable. That's basically money that your customers owe you, that they have agreed to pay. So you've already engaged into a transaction, but you have not received the money yet. This is, by the way, very, very, very typical in business to business cases, right? So if you're a company that is selling their products to other companies, usually the transactions are not paid for right away. A typical time frame for paying will be 30 days, 60 days, or even 90 days, right? Where what you're doing is you're essentially financing your customer for a little while. Okay, so this is money, the accounts receivable is money that is owned by your customers. Then we have liabilities. What kind of liabilities do firms have? Well, we're going to make distinctions mostly depending on the time frame. So you're going to have current liabilities. Those are short-term accounts that needs to be paid by the firm within a year. So for example, you will have within current liabilities amounts of money that you own maybe that need to be paid within that year. So if you have a mortgage and the mortgage is 20 years, most of that mortgage will not be a current liability, but whatever needs to be paid for that year will be. Okay. Then you have accounts payable, which is basically the amount of money that we own to our own suppliers. So like I was mentioning before, we will have our customers that will own us money. Well, this is the money that we own to other companies because we are their customers. So for example, if we get our raw materials for production from another company, and that transaction that we have already not paid, but we have already received their raw materials for our firm, and that will be part of our accounts payable. And then we have accrued expenses, which is basically all unpaid obligations that the organization have. This is just a more generic expense account. And then finally, to complete our accounting equation, we have owner's equity, and these are going to be, like I think I've mentioned already a couple of times, including both initial investment or contributions that are put forth by the owners or the founders of the organization. So this is the money that the company was started with, right? It will be here, or any other investment made in the company by investors through buying shares, right? And also the amount of money that has been retained by the firm because of there was an excess of money from previous years of operation. So these will be profits that are pushed back into the balance sheet to be invested within the organization for future growth. Okay, that's retained earnings. Okay, so let me show you a simple example of double entry bookkeeping with a few transactions so that you can see how this will look like in a simplistic environment. So imagine that you have a small firm. This is a small firm that it's a flower shop, right? So let me just walk you through a few entries so that you can see how you're always entering everything in two sides of the equation. So notice at the top of this, we have the accounting equation, right? So you can see here we have assets are equal to what? Liabilities plus owner's equity. So these are the three broad categories of accounts that we're going to have. And within assets, now we have three accounts. We have cash, we have equipment, and we're going to have inventory. This is a simplistic scenario. In reality, you'll have many more accounts, but they will be similar to this. One is very short term. The other one is assets that you have that are maybe medium term. These are durable things, okay? And then finally you have inventory. This is the stuff that you're going to be selling, that you're keeping track of, right? So this is what you have. In their case, this will be flowers, right? But inventory will change depending on what the organization is, right? On the liability side, we have debts that we own to our suppliers and loans, okay? And then finally, on the owner's equity, we just have equity. In reality, again, you might have multiple accounts, okay? So it only gets a little more complicated, but at least you're gonna see the big picture. So let's start with the first entry, right? In the first entry, we have the money that was invested by the owner of the shop, right? Which were $2,500, right? And it comes from cash, right? So this was cash that was put into our assets. So now we actually have the money that was given or gifted by the owner, which is Anna, to the firm. So now it's part of the firm, and it shows in the assets side as cash because we actually have the bills. And also it shows on the right side of the equation as owner's equity. This is the amount of money that Anna has invested into the firm. So yeah, the equity account goes up by the same amount as the cash account, okay? Maintaining the equity here, the equality in the equation, okay? So notice this is what we mean by double entry. You enter on the left and you enter on the right, okay? Now we're gonna do the same thing with the next entry, right? The next entry is a loan that we got from the Small Business Administration organization, which, as we have seen in the past, it's a government organization that helps small businesses. So they've given us a loan, and that loan is going to translate to $5,000 of cash. So they've given us a check, maybe a teller's check, that we can take to our account in the bank and just put it in the account for the organization, right, for this shop. And now we own the Small Business Administration $5,000. So we reflect as a loan in our liabilities side the $5,000 that we just got in cash. Okay, so it's something that we're going to have to return over time. Okay, what else do we see here? We have a purchase for some furniture, maybe. Okay, and you can see that that's reflected as a decrease in our cash. So we actually took some of that money that we had in our cash box, right? And we just bought something with it. And now we do have that piece of furniture reflected as an asset under equipment. Okay, notice again, the equation balances out because what you put as negative, now it also shows as positive. So you're really not adding anything on the left side of the equation, and because of that, the right side of the equation stays the same. Okay, notice that again, it zeroes out. Okay, it balances out, which is what we need. Okay, then we have the same thing with inventory, right? We bought some flowers so that we can sell them later, right? And those flowers cost us $2,000. Okay, that came out of our cash, so it's money that we spent, and now we do have $2,000 worth of flowers in our inventory that we can sell at the store. Okay, good. So again, double entry. Both the dual entry here zeroes out on the left side of the equation, which is the asset side, and because of that, the liabilities and owner's equity don't need anything added because it already zeroes out. Okay. Then we have had some more flowers that we have actually purchased, right? But now we have purchased that instead of with cash, we have actually bought them from one of our suppliers, right? So we've spent $325 in roses, apparently, and we didn't buy those with cash. We bought them by telling our suppliers that we'll pay them at a later time, right? So now we're going to have a liability added to us, which is those $325 that we're going to have to pay maybe a month from now or 3 months from now. It depends on the terms and conditions that we have agree upon with our suppliers, but we're going to have to pay that back. So notice that again, there's a double entry on the left side of the equation and right side of the equation to make sure that it balances out. Okay. And then finally, the last entry that we have here is the amount of roses that we sold on the first month of operation. And as you can see, we got $2,000 in cash. Okay. Notice, however, that we are selling those flowers at a profit, so we're charging customers more than it did cost us. In this case, we got $2,000 in cash from the customers, but we spent $1,500 in those flowers. Okay, so those were flowers that cost us $1,500, but we sold them for $2,000. This is the way business works, right? I'm sure nobody's surprised over this. So there's a difference between these two entries, unlike before, right? The difference is $500, and that $500 needs to show up in the right side of the equation, otherwise the equation will not be balanced. And the ways that it shows is as equity because it's retained income, right? This is a retained profit that we are keeping within the organization for at a later time invest in it. Okay, so these are several examples of the double entry bookkeeping, so that you see there are many more complicated transactions that you can actually do if you dedicate yourself to accounting, but I hope this actually clarifies what is the basic concept of double entry book. Now, finally, we're going to talk about a different aspect of accounting. So we've talked mostly about the three financial statements, which is information that goes both externally to the government and any other stakeholders to basically make decisions about investment and taxes, right? But what happens with the financial statements is that they are very complex. There are a lot of numbers, and people have a hard time making decisions just by looking at large tables of numbers. So what we do is we try to summarize a lot of that information, creating this sub-branch of finance, which is called ratio analysis. And essentially, ratio analysis tries to summarize the information that it's embedded within the income statement, balance sheet, and any other financial statement, and try to come up with metrics that are useful for decision making, right? So it basically compares different pieces of information within the financial statements, and it prepares the computation in a way that will be useful to learn something about the organization. Okay, so now let me say a couple of things. One is ratio analysis. It's complicated because there are many ratios that you can use for, okay? But ratio analysis is only useful in context, okay? So A, you need to pick multiple ratios, like we're gonna see later. But B, and more importantly, you need to compare those ratios to something else. And you can use it for different aspects. So you can use it to compare to the ratios in other years from the same company to see how the company is doing relative to the past. Okay, that will be a useful thing to know if you're an investor, to know whether we're improving or getting worse, and if we're getting worse in what aspects. Okay. Also, another thing that could be useful for you to do is to compare the ratios that we're going to compute later to those of other companies, right? Maybe competitors, right? To see which one is doing better where. And potentially, you might want to compare those ratios to what the company said they were going to achieve versus what they actually did, right? So all these comparisons are actually fair. And like I said, ratios on themselves don't tell you a lot, but relative to something else, they give you quite valuable information for many other things, but particularly for investments. So the first ratio I want to talk about is profit margin. It's simple. It's just computed as the ratio between net income and sales. So it uses only information from the income statement. So it doesn't contain anything from the balance sheet and income statement like some of the ones we'll see later. Okay. So this is going to tell you what percentage of the sales that we're actually obtaining are indeed in profit. So this is in a way looking at the profitability of the company. Okay, notice that this is going to be smaller than 1, right? Because your net income is going to be always smaller than your sales. Okay. Then another profitability ratio that you might look at is return on assets, which is similarly defined to the one we were looking at before, but now we divide our net income, which is our profits, divided over our total assets. So this is a combination of both income statement information, which will be the net income, right? And balance sheet information, in this case, the total assets. So this is looking at basically how effectively are we using our assets to convert them into profits. So if we have a lot of assets, you will expect that we get a large amount of income. So this is just looking at the percentage of conversion of those assets into profitability. Another metric that we can use is return on equity, and that's similarly defined as net income divided over stockholders' equity. So this is a metric that is looked up a lot in investment. Another way, this is known as return on investment. And the reason why it's called return on investment is for every dollar that you put in as investment into the company, right, which is going to be here, how much money do I get, right? So it's basically looking at the percentage of profitability that I'm obtaining from the firm, okay? So this is a metric that is used a lot for investment purposes. After looking at profitability, now we're going to look at other asset utilization ratios. Those are looking about how effectively and efficiently we're using the assets that we have at our disposal within the firm. So the first thing I want to talk about is receivables turnover. This is basically looking at how the company is turning their accounts receivable, which, if you remember, is essentially the amount of money that you are owed by your customers, into actual cash, right? So you want to see how quickly are you basically able to collect payments on that credit that you've given your customers. And the way you compute it is the ratio between your sales and the amount of accounts receivable, okay? And you want to have that amount to be as large as possible. So you want to have small receivables and large sales, if possible. That tells you that you are actually quickly moving through them, right? Then you have inventory turnover, which is looking at the ratio between sales and inventory, okay? And it indicates basically how quickly you're selling inventory within the firm. So if you have a car dealership, for example, you want to know what is the number of times that you go through inventory, meaning how long are the cars sitting in the store without actually being bought, right? So a way of looking at that is looking at the ratio between your sales and the amount of inventory that you actually are holding at any given time. And then we have total asset turnover, which is basically looking at your sales divided over the total amount of assets that you have. And this is an overall efficiency metric that it's looking at whether you are able to use all your assets efficiently or not. Of course, the larger this number, the more efficiently you're actually using your assets, because you're making more sales with a smaller amount of assets. And then you have liquidity ratios, which are looking at whether you can actually pay your short-term debt or not, and how easy that's going to be for you. So current ratio looks at the short-term debt you have and your short-term liabilities, right? So your current liabilities and your current assets. Remember, current assets are for the most part cash and things that can quickly turn into cash, so you can just face those short-term payments that you have to make. And of course, you want this ratio to be as large as possible, so you have a large number of assets to face those payments and hopefully a small amount of current liabilities. If this ratio is too small, it might mean that you're going to have a hard time facing your creditors and making payments, so you might actually go bankrupt. So this current ratio is particularly important. And finally, I have quick ratio, which is also known as the asset test. And it's basically a more stringent version of the previous ratio, which is looking at whether you can actually face your short-term creditors and if you're going to have any liquidity issues within the firm. And the reason why it's more stringent, if you look at the formula, it's essentially the same formula. This is what we had before, right? But now what you're doing is from the current assets, you are removing the current inventory. And the reason why you're doing that is because selling that inventory and converting that into cash might actually not be straightforward. Oftentimes, there are longer sales cycles. So for you to be able to take your inventory and sell it and get some money out of it so that you can face those short-term creditors that you have, it's probably not very realistic. Otherwise, you will just operate the business and that's it, right? So because of that, you remove from your current assets your inventory. And this is a more stringent test of liquidity, and because of that, it's probably the most commonly used one.